In this video, I present Chapter 6, devoted to a Markovian framework for life and health insurance. The purpose of this chapter is to move from the classical two-state model of a single life to a much richer representation in which an insured person, or a policy involving several insured persons, may move through several possible states. These states can describe being alive, disabled, recovered, unemployed, retired, widowed, surrendered, or deceased. The chapter shows that a continuous time finite state jump process provides a unified language for these situations. It also explains why this framework is central in actuarial science. The path followed by the insured determines the timing of premiums, the payment of annuity benefits, lump sum benefits at transition times, and the mathematical reserve that must be held by the insurer. The central idea is that the whole policy history can be represented dynamically by a stochastic process, and that, under the Markov assumption, the current state is enough to describe the probabilistic law of the future. The presentation is organized in 5 parts. I first summarize the chapter, then introduce finite state Markov modeling and transition rates. I then turn to cash flows along a trajectory before discussing premiums, benefits, reserves, and Thiele's equation. The final part explains how martingales, likelihood-based inference, and simulation all arise naturally from the same Markovian structure. This chapter develops the general continuous time, finite state framework that underlies most modern life and health insurance models. Instead of describing a contract only through one survival time or one death time, the policy history is represented by a jump process, taking values in a finite set of states. This makes it possible to model disability insurance, long-term care, unemployment covers, contracts on 2 lives, surrender, recovery, or any situation in which several transitions are relevant. The key modeling objects are transition probabilities, instantaneous transition rates, and the infinitesimal generator. Transition probabilities describe the chance of being in one state at a future time, conditionally on the present state. Transition rates describe the local intensity of moving from one state to another. The generator gathers all these local rates in a matrix and drives the Kolmogorov equations. This probabilistic structure is then connected with actuarial cash flows. Premiums may be paid while the insured is in some states, annuity benefits may be paid while the insured occupies other states, and lump sum benefits may be triggered by specific transitions. Reserves are obtained as conditional, expected, present values of future benefits minus future premiums. The chapter also derives Thiele's equation, which provides a local balance equation for the reserve in each state. Finally, the same structure supports martingale methods, statistical estimation of transition rates from observed trajectories, and simulation of future paths. The main limitation is also important. The Markov assumption ignores the duration already spent in the current state, which is why semi-Markov models are needed when duration matters. We now enter the modeling part of the chapter. The aim is to translate the life or health insurance contract into a finite state path. This requires 3 ingredients: a set of possible states, a stochastic process describing the state occupied at each time, and assumptions on how the process can move between states. A life or health insurance policy can be represented by a state process. At each time, the process indicates the status of the insured or of the policy. The state space is finite, but it can be flexible enough to include all the relevant actuarial situations: alive, disabled, unemployed, hospitalized, recovered, surrendered, widowed, or deceased. In contracts on several lives, states can also represent joint statuses, for instance, both lives alive, only one survivor, or both deceased. The chapter assumes that trajectories are Kedleg, meaning that they are right continuous with left limits. This is the natural mathematical convention for jump processes, because it allows well-defined states immediately before and after a transition. It is also assumed that only finitely many jumps can occur on each bounded time interval. This excludes explosive behavior and is consistent with observable insurance events. The important point is that premiums and benefits do not depend only on the final state. They depend on the entire path, which states are visited, when transitions occur, how long the insured remains in a given state, and which payments are triggered by jumps. This representation is particularly relevant for level premium contracts. In such contracts, the premium is fixed at inception, although the probability of future benefits generally increases with age or with deterioration in the policy state. The insurer must therefore accumulate reserves during early periods in order to finance later periods when expected outgo may exceed premium income. The mark of property is the central, simplifying assumption of the chapter. It says that, conditionally on the current state, the previous history does not provide additional information about the future. In the chapter, this is expressed in equation 6.2. The condition is imposed only for histories with positive probability, so that the conditional probabilities are meaningful and impossible histories are excluded. Actuarially, this means that if a policy is currently in a disability state, the future law is assumed to depend on being disabled now, but not on the detailed sequence of previous states that led to disability, unless that information has been included in the state definition itself. Transition probabilities are then introduced as the probability of being in a destination state at time t given an origin state at time s. These probabilities form a stochastic matrix with non-negative entries and rows summing to 1. Once the initial distribution and all transition probabilities are known, the finite dimensional distributions of the Markov process are determined. The homogeneous case is a useful benchmark. Transition probabilities depend only on elapsed time, not on calendar time. However, this is often unrealistic in actuarial applications because mortality, disability incidence, recovery, or surrender may vary with age, duration, underwriting period, or economic conditions. The chapter therefore emphasizes non-homogeneous and locally homogeneous models, which retain tractability while allowing the rates to change over time. The next step is to move from transition probabilities over finite intervals to instantaneous transition rates. The transition rate from state I to state j is defined in equation 6.4 as the limiting probability of moving from the current state to the destination state over a very short interval divided by the length of that interval. It is crucial to stress that this object is not a probability. It is a rate per unit of time, just like the force of mortality in the two-state survival model. Over a small interval, the probability of making a specific transition is approximately equal to the corresponding rate multiplied by the time step. This first-order approximation is stated in equation 6.7. The exit rate from a state is then obtained by summing all transition rates out of that state. It measures the total local intensity of leaving the current state for any possible destination. Equation 6.9 gives the corresponding approximation for staying in the same state. The short-term stay probability is 1 minus the exit rate times the time step up to a negligible term. This is the local mechanism behind continuous time Markov modeling. It also explains why simultaneous or multiple jumps over a very short interval can be ignored at first order. In insurance terms, the insured is exposed to several competing transition risks, and the exit rate aggregates them before the destination state is determined. The Chapman-Kolmogorov equations provide the consistency condition for transition probabilities. They say that a transition from time s to time t can be decomposed through any intermediate time, u, by summing over all possible states occupied at u. This is equation 6.8 in the chapter. The result is fundamental because it connects local and global descriptions of the process. The Kolmogorov equations then describe how transition probabilities evolve when the terminal time or the initial time changes. The forward equations, given in equation 6.10, express the rate of change of the probability of ending in a state as the difference between flows leaving that destination state and flows entering it from other states. The backward equations, given in equation 6.11, provide the corresponding evolution with respect to the initial time. All instantaneous rates are gathered in the infinitesimal generator. Its off-diagonal entries are the transition rates, and its diagonal entries are the negative exit rates, so every row sums to 0. In matrix form, the forward system is driven by multiplication of the transition matrix by the generator. In the homogeneous case, the generator is constant, and the transition matrix is obtained by taking the matrix exponential. This is the continuous time analog of repeatedly applying a transition matrix in discrete time. It is one of the main reasons why Markov models are computationally attractive in actuarial work. The chapter then introduces a practically important specification. Transition rates are piecewise constant. This assumption is stated in equation 6.15. It means that on each interval of a given time partition, the process is locally homogeneous. In actuarial applications, this is a natural modeling choice because intensities are often estimated or tabulated by age bands, policy years, calendar periods, underwriting classes, or claim durations. Within each interval, the generator is constant, and the transition matrix is computed using a matrix exponential. Across several intervals, equation 6.17 shows that the full transition matrix is obtained by multiplying the homogeneous transition matrices corresponding to the intervals crossed between the initial time and the final time. This is a very useful computational bridge. It allows us to retain a continuous time formulation while using data and assumptions that are often available only on a discrete grid. It is also convenient for numerical implementation because each factor is the exponential of a finite matrix. In hierarchical models, such as models with absorbing states and no return to previous states, these matrices often have triangular structure, which simplifies calculations further. More generally, the piecewise constant approach is one of the standard ways of computing prices and reserves in multi-state life insurance models, especially when the rates vary with age or duration but remain constant within annual intervals. The next part moves from the probabilistic dynamics of the state process to the financial interpretation of a realized path. The question is no longer only where the insured may be in the future, but also which premiums and benefits are generated along the way. The figure illustrates the essential idea of the chapter. In a multi-state model, cash flows are attached to the trajectory of the process. The process starts in state E0 at time 0, it remains there until the first jump time, then moves to state E1, later returns to E0, and finally moves to state E2. The horizontal parts of the path correspond to periods spent in a given state, and the vertical jumps correspond to transitions. Premiums and benefits are triggered differently, depending on the segment of the path. While the policyholder remains in state E0, premiums are paid according to the premium function associated with that state. When the process moves to state E1, annuity-type benefits may be paid during the time spent in that state. The notation in the figure indicates that these benefits can depend not only on calendar time, but also on the duration already spent in the state. When the process later returns to A0, premiums may resume. Finally, when the transition from E0 to E2 occurs, a lump sum benefit is paid at the transition time, and its amount may depend on both the time of transition and the duration since the last entry into the origin state. This diagram is important because it shows why the multi-state framework is richer than a simple survival model. The actuarial value of the contract is generated by the whole path. Time spent in states determines continuous payments, while jumps determine transition benefits. The figure therefore provides the link between stochastic trajectories and the premium, benefit, and reserve formulas that follow. We now translate the pathwise description into actuarial valuation formulas. The next slides introduce the cumulative premium and benefit processes, the equivalence principle for premium calculation, the conditional reserve, and the reserve dynamics in the duration-independent case. The chapter formalizes cash flows using counting processes and state indicators. For each ordered pair of distinct states, the counting process records the number of transitions from the origin state to the destination state up to time t. Its stochastic intensity is the transition rate multiplied by the indicator that the process is currently in the origin state. This means that a transition can occur only when the policy is actually exposed to that transition. The cumulative benefit process is then written in equation 6.22 as the sum of two components. The first component contains annuity-type benefits paid while the insured occupies a given state. These payments may depend on calendar time and also on the duration already spent in the current state. This is important for health insurance, disability insurance, long-term care, or unemployment insurance, where the benefit amount may change with duration. The second component contains lump sum benefits triggered by transitions. When the process jumps from one state to another, the corresponding capital is paid, possibly as a function of time and duration. Premiums are represented in a similar way, but are attached to time spent in states rather than to transitions. For example, premiums may be payable only while active, cease during disability, or restart after recovery. This notation is compact, but it is highly expressive. It allows a single model to represent a wide variety of life and health insurance contracts by specifying which state payments and which transition payments are present. Premium calculation is based on the equivalence principle. In equation 6.23, the expected present value of future premiums is set equal to the expected present value of future benefits over the term of the contract. This is the classical actuarial pricing principle when a large portfolio of similar independent policies makes expectation a meaningful pricing target. In the multi-state setting, the premium side is obtained by summing over all states. A premium scheduled in a given state contributes only when the policy is in that state, and the corresponding weight is the transition probability from the initial state to that state. The benefit side has two types of terms. State benefits are valued by discounting and weighting the payment by the probability of occupying the relevant state at the payment time. Transition benefits are valued by adding the transition intensity because payment occurs only at the instant of a jump. In the duration-independent case, equation 6.24 gives a concise expression involving transition probabilities, transition rates, state benefits, and transition benefits. Once the pattern of premiums has been specified, this equation determines the premium amount. It may determine a single premium at inception, a level annual premium, or a more general schedule of premiums depending on the states. The chapter also notes that the probabilities, transition rates, and discount factors used for this calculation are often prudent first-order bases, distinct from best estimate assumptions, thereby creating technical margins. The reserve is defined as the conditional expected present value of future benefits, minus future premiums, given the information available at the valuation date. This definition is the natural multi-state analog of the prospective reserve in single life insurance. The conditioning information is the history generated by the state process up to time t. Under the Markov property, the future distribution of the process depends on this history only through the current state, provided all relevant information has been included in the state definition. When benefits or transition payments depend on the duration spent in the current state, the current duration must also be retained. The reserve can therefore be written as a state-dependent and duration-dependent quantity. If benefits are independent of duration, the reserve simplifies to a vector indexed only by the current state. This vector representation is particularly useful for computation because it combines naturally with transition matrices. The chapter also emphasizes an important technical property. The transition matrix is invertible. This follows from Liouville's formula applied to the matrix differential equation for the transition matrix. Equation 6.28 shows that the determinant is a strictly positive exponential involving the trace of the generator. This guarantees that reserve relationships between different dates can be manipulated algebraically. In actuarial terms, the reserve is the amount needed at time t, conditional on the present state, to fund the future net obligations of the insurer. When benefits and transition payments do not depend on the duration spent in the current state, valuation formulas become considerably simpler. The chapter introduces the discounted transition probability, which is the product of the financial discount factor and the transition probability from an origin state to a destination state. This object can be interpreted as the present value at the origin time of a unit payment made at the future time if the process is then in the destination state. In this setting, the pure single premium at inception is given by equation 6.25, and the reserve in state I at time t is given by equation 6.26. The reserve formula separates three types of future cash flows. First, there are annuity-type benefits paid while the process occupies each possible future state. Second, there are lump sum benefits paid when transitions occur, and these are weighted by the relevant transition intensities. Third, there are future premiums, which reduce the insurer's net liability. The same formula applies at any valuation time by conditioning on the current state and integrating over all future times until the end of the contract. Matrix notation provides an additional computational advantage. Over a sub-period, The reserve at the beginning can be decomposed into the expected present value of cash flows during the subperiod, plus the discounted transition matrix times the reserve at the end. This makes backward recursion and numerical implementation especially transparent. Thiele's equation is one of the central results of the chapter. It gives the local dynamics of the reserve in each state in the duration-independent case. In the chapter, this is equation 6.29, and the integral representation that solves it is equation 6.30. The equation has a direct financial interpretation. The reserve earns interest at the force of interest, which increases the available fund. Premium income also increases the reserve, while annuity-type benefits paid in the current state decrease it. The most characteristic term is the transition term. If the process jumps from the current state to another state, the insurer must pay the transition benefit and then hold the reserve appropriate to the new state. At the same time, the reserve held for the previous state is released. The net amount at risk is therefore the transition benefit plus the new reserve minus the old reserve. Multiplying this amount by the transition intensity gives the expected local cost of the transition. Thiele's equation states that, after accounting for interest, premiums, benefits, and transition costs, the reserve must satisfy a local balance condition. This is the continuous time, multi-state generalization of the classical reserve differential equation in life insurance. The equation is useful both conceptually and computationally. Conceptually, it explains the economic mechanics of reserving. Computationally, it allows reserves to be obtained by solving a system of differential equations with appropriate terminal conditions. The chapter then interprets the reserve equation through the decomposition between capital at risk, risk premiums, and savings premiums. The capital at risk for a transition from one state to another is the transition benefit plus the reserve required after the transition minus the reserve held before the transition. This is the amount economically exposed when the jump occurs. If the capital at risk is positive, the transition creates an additional cost for the insurer. If it is negative, the transition releases more reserve than it requires and may be financially favorable. The instantaneous risk premium is obtained by multiplying this capital at risk by the transition intensity. It represents the expected cost per unit of time generated by that specific transition. Summing over all possible exits from the current state gives the total risk premium associated with transition risk. The savings premium is defined as the change in the reserve after removing the interest earned on the reserve. This captures the part of net premium income used to build or release the savings component of the contract. The final identity on the slide shows that net cash flow in a state can be decomposed into a savings component and a risk component. This decomposition is very useful pedagogically, because it clarifies the dual nature of many life and health insurance contracts. They combine a risk pooling mechanism, which finances random transitions, with a savings mechanism, which accumulates funds over time to meet predictable future obligations. The last technical part of the presentation shows that the same Markov structure also supports stochastic analysis, estimation, and simulation. This is important because a useful actuarial model must not only price and reserve contracts, it must also be estimated from data and used to generate future scenarios. The martingale approach reformulates the preceding reserve theory in stochastic process terms. For each transition, the observed counting process is decomposed into a predictable compensator and an innovation term. The compensator is the accumulated exposure-weighted transition intensity, and the difference between the counting process and this compensator is a martingale. Under standard integrability conditions, these compensated counting processes are square integrable, and martingales associated with different transitions are orthogonal. This is the multi-state analog of the martingale representation used in the single life model. The chapter then defines the conditional value process as the conditional expectation, given the current information, of the total discounted net cash flow over the whole contract. By construction, this conditional expectation is a martingale. It can be written as the discounted net cash flows already observed plus the discounted reserve corresponding to the current state. Applying the stochastic integration formula for jump processes separates two components, a finite variation drift and a martingale increment. The drift must vanish because the whole conditional value process is a martingale. Setting this drift equal to 0 recovers exactly Thiele's equation. The remaining martingale term measures the random deviations of realized transition experience around the actuarial balance. This approach is powerful because it connects reserving, risk analysis, and stochastic fluctuations within a single framework. The chapter concludes the technical development by explaining how transition rates can be estimated and how trajectories can be simulated. For one observed trajectory, the likelihood contains two components for each possible transition. The first rewards observed jumps through the logarithm of the transition rate at the jump time. The second subtracts the integrated exposure to the corresponding transition intensity. For a portfolio of independent insureds, the same expression is summed over all trajectories by aggregating transition counts and exposures. Under the piecewise constant assumption, the maximum likelihood estimator has the simple and intuitive form given in equation 6.31. The estimated transition rate is the observed number of transitions from the origin state to the destination state divided by the total exposure time spent in the origin state. This is the multi-state version of the deaths over exposure estimator familiar from mortality analysis. Simulation uses the same rates. Starting from the current state, one draws the next sojourn time using the survival function determined by the exit rate. Once the jump time is obtained, the destination state is selected with probability proportional to its transition rate among all possible exits. When rates are piecewise constant, the inversion step and the choice of destination become especially simple. This closes the actuarial loop. The same estimated intensities can be used for pricing, reserving, stress testing, scenario generation, and portfolio risk measurement. We now close the chapter by emphasizing what has been achieved and what remains outside the Markov framework. The main message is that Markov models provide a coherent and tractable foundation, but they must be extended when the time already spent in a state is actuarially relevant. The chapter provides a unified actuarial language for life and health insurance contracts involving several states. Starting from a finite state jump process, it connects the probabilistic dynamics of the policy with the financial cash flows generated by premiums, annuity benefits, transition benefits, and reserves. The main strength of the Markovian framework is tractability. Transition probabilities are driven by transition rates and the generator. The Chapman-Kolmogorov and Kolmogorov equations allow probabilities to be computed consistently. Piecewise constant rates lead to matrix exponentials and products of transition matrices, which are well suited to actuarial tables and portfolio data. The same framework also leads to prospective reserves, Thiele's equation, capital at risk decompositions, martingale representations, likelihood estimation, and trajectory simulation. This internal coherence is the reason why multi-state Markov models are so important in actuarial science. However, the chapter also makes clear that the Markov assumption has a significant limitation. In many applications, the future does depend not only on the current state, but also on how long the insured has been in that state. The probability of returning to work after 5 years of unemployment is not the same as just after job loss. Recovery from disability, length of hospitalization, widowhood effects, and selection after policy inception all involve duration dependence. The natural extension is therefore the semi-Markov framework, where transition intensities and sometimes benefits depend explicitly on the duration spent in the current state. This prepares the transition to the later part of the book.